This is Alpha. We continue to talk about replacing emotional operations with standardized transactions, stock selection, of micro-analysis. Previously, we discussed the macro factors, how to classify and prioritize market information. Next, we will discuss some micro directions for individual stocks. I will explain the most important part of my analysis framework, how to conduct fundamental and technical analysis on some specific targets. Regarding my views on technical analysis and fundamental analysis, I am very sure that, in the current ordinary transactions, technical indicators cannot be relied on to make trading decisions, and Buffett's successful experience of picking up bargains in fundamental analysis cannot be replicated. And when we make decisions, there are many more important information that need to be given priority. We know that in fact, many times there is nothing particularly important happening in the market, and the entire market is in a stable state without waves. So what do we rely on to guide transactions at this time? Frankly speaking, no matter whether it is technical analysis, fundamental analysis or any other analysis, it cannot guarantee that we will make a profit. If you want a crystal ball that can predict the market, I am sorry to disappoint you. However, we can combine key information from all aspects to avoid some low-level mistakes and emotional transactions. It reminds us of risks when we are optimistic and reveals opportunities when we are pessimistic, helping us make decisions with a higher risk-return ratio. Using objective market information in key dimensions to help us make rational decisions is the main function of my trading framework. So, which dimensions are key dimensions? Don't worry, let me tell you slowly. We know that the market is full of information from all aspects every day, some are good and some are bad, but we should not consider these factors equally. Some news is more important, some are relatively minor. I will roughly classify and prioritize this information from two perspectives. These two perspectives are the capital side and the emotional side, which is also my analysis idea all the time. The information on the capital side is related to the long-term performance of the target, while the information on the emotional side is closely related to the short-term performance of the target. The capital side is in a basic position. When there are adverse risks on the capital side, we should avoid entering the market. On the premise that the risk of the capital side can be measured, let's look at the information on the emotional side. The priority of the capital side and the emotional side cannot be reversed. We will change the trading concept from the holding period is divided into two categories: long-term strategy and medium and short-term strategy. Among them, fundamental analysis occupies a major position in long-term strategy, while technical analysis occupies a position in medium and short-term strategy that is equivalent to fundamentals, or even slightly higher than fundamentals. The long-term strategy is actually very simple. It mainly judges whether it is an ideal long-term investment goal by combining the quality of the company itself with its growth potential. This is not based on feelings. There should be rational analysis and rigorous evaluation. These words sound a bit like stock analysts. Yes, you are your own stock analyst. Don't think you can't do it well just because you are not a professional. The threshold of fundamental analysis seems higher than that of technical analysis, but when you get started, you will find that stock analyst is just a profession, not a certification of ability. Instead of calling it, every profession has its own specialty, is better to say, practice makes perfect. If you study this field with concentration, and you have your own ability to understand things and analyze problems, you can definitely do much better than ordinary stock analysts. After all, most stock analysts only regard this profession as a means of making a living. Stock analysts are not trading masters. Regarding how to conduct fundamental analysis, you need to rely on your own continuous accumulation and learning to form a set of effective analysis models. In this regard, I cannot provide you with a deeper understanding. I think my research in this area is not in depth enough, and I need to do more homework. But here I can share some immature views. The first point: what information should be mainly used for the company's fundamental information? In today's popularization of AI tools, value investment masters like Buffett have difficulty finding good stocks. So the method of discovering investment opportunities based on the discovery of fundamental information such as financial statements is no longer of much exploration value. Investors need to go beyond traditional financial analysis and fundamental analysis methods and use some non-traditional methods to do fundamental research work. At this time, some rare personal qualities are often the ever-bright light on the road of exploration. For example, the first is professional knowledge and experience. Having a deep understanding of the field you are familiar with can more efficiently screen and verify information. The second point is analytical ability, integrating multiple data sources, and building a unique investment logic, rather than simply relying on a single indicator. The third is execution, staying calm and acting decisively when market sentiment fluctuates, and avoiding missing opportunities due to hesitation. The fourth is continuous learning, keeping up with technological progress and market trends, and dynamically adjusting strategies. We know that the openness of information does not mean that all investors can effectively use information, and the key to success lies in how to integrate, analyze, and execute this information. For example, two investors face the same financial report. One only looks at the surface data, while the other combines industry trends and non-traditional data for in-depth mining. Then their investment results may be completely different. The above-mentioned personal abilities are difficult for ordinary investors to possess at the same time, of course, including myself. Next, I will talk about the three main aspects of information that I look at in my fundamental research on long-term strategies. First, is there a big risk in the company's industry prospects? The greater the potential, the better. For example, there is a company that does tax planning. Its historical performance is very stable and its financial indicators are also very healthy. However, as its main business, personal tax planning does not face huge challenges in the short term, but in the long term, it is hard to say. It is likely to be replaced by AI technology. Don't touch such companies. Don't buy when the market is widely bullish. We often hear a saying that good news is bad news. For an investor who attaches importance to risk control, this sentence makes sense. A good company may reach a short-term price high when everyone is bullish for it. For example, after Trump won the second presidential election, Tesla's stock price soared all the way, and it nearly doubled without any substantial operating benefits. Social media is full of worshipful praise for a company. As a rational investor, no matter how good the company is, don't squeeze into the crowd that surrounds it. In the investment field, any worship that starts with emotion is illusory. Third, I think the company's investment agent is a crucial factor. For a company with huge growth potential, if the CEO is a mediocre defender, then the ceiling of the company's development will be discounted. I believe that friends who have worked have this experience. What the boss likes, the subordinates will be even more. The personal level of a company's CEO is the level of the company. His style is the style of the company. Subordinates are not shareholders. He is only responsible to his superiors, not to the shareholders of the company. Such a CEO cannot bring greater development to the company. Let's talk about the technical aspects of long-term strategy. In short, it is to avoid intervening at high levels. When the market is not so good, use the price points of technical analysis and buy in batches patiently. Every 3 to 5 months, check whether there are any directional changes in the fundamentals. If the logic of the fundamentals changes, make corresponding trading decisions. The above are some personal insights on long-term investment strategies. We will continue to discuss medium and short-term strategies in the next issue. Okay, let's stop here. We will continue in the next issue.